some good stuff on that as well.
Hey, we're live. Hey, it's 7 p.m. Eastern. It is June the 28th. Welcome to another Unmissable Sunday Show. Hi, Benny.
Hey, buddy. The Unmissable Sunday Show. Let's go.
Let's go. You want to start with AI, right? Let's do it. Okay. And I'm pleased with the title of the show, by the way, but we'll get to Walsh later. Anyway, you go.
Yeah, so basically, Microsoft's down 20% for June. Look at this is the UBS in black is the UBS Hyperscaler index. You just got to look at Meta and Microsoft and all these guys. They're spending the money.
Weight? Is that an equal weight?
Money. Yeah, equal weight. I think so. Actually, I'd have to check that, to be fair. So don't quote me on that. But the point is, you can just look at the charts of the individual 5 stocks, whatever, and SpaceX, to be fair as well. And because I included them in all my models and all my stuff. Now SpaceX is incorporated. Well, they've been taking pain since the month started, basically, right? Like getting drilled. And, what is that? About a 17% drawdown across the board. And there you have the beneficiaries, right? The SOX, the AI Capex index, the memory. Everyone knows this stuff. That's a gap right there. And so I had to throw in a little Rupert Love there, mind the gap, the tube, baby.
I love it. But
so go ahead.
Go on. I mean, the issue with this sort of, the semis guys who are basically taking all of the AI capex from the hyperscalers, the hyperscalers can decide to stop spending money.
Correct.
Right?
That's what we're going to get to, basically. The idea here is, I think the key thing to focus on right now is how much pain are they really going to take? In the last couple of weeks, we see Satya, the CEO of Microsoft, come and saying some, things about Frontier Labs. We have the administration saying, oh, they can release Mythos, but only to a select group of companies. We have, the idea that people are warming up to that these, open source, other models, this is global, is catching up. I subscribe to a Japanese model. It's pretty good. It's almost in line with Mythos. Just in general, I think what's going on is the market's realizing this is a commodity, right? This is a commodity, and these guys are all in on a commodity that doesn't have pricing power. They're already cutting prices. And by the way, this is not like in the past. Like if you use the .com analogy, China is a competitor here, right? China is a real competitor. Now Japan is in there. So this is one of these things where the grip on this that Silicon Valley's enjoyed historically might not be there this time. And that's not something I think Wall Street is. They're starting to get through their head on that, right?
They're going to ban open source models.
It's unbelievable. And then so let's go to the next chart then, because I just want to run through this whole narrative of thinking. That's basically those lines were, I converted that from Bloomberg chart to our stuff. So those trees, but look, this is under the 300-day moving average, this UBS hyperscaler index. This is the third time it's happened since, let's just call that 22 is when this started, the ChatGPT 4.
November 22, yeah.
Right, so those have all been buys. Question is right now, are you buying the hyperscalers and shorting the CoreWeave, shorting all the picks and shovels? Because at what point are they going to say, hey, enough is enough? We might not be there, but I'm saying on the bottom I put, that's the CDS market. Well, when Rupert and I had my buddy Amish on, and we were talking about CoreWeave as a short, well, CoreWeave CDS up 100 bips this month, okay? Oracle, the model, Bloomberg's models pricing their CDS should be at 220. That's 50 basis points wider. In the private markets, it's even wider. They're above 300 in the private markets now. SpaceX comes out and does a $25 billion bond issuance last week, immediately sells off 35 bips in cash and 26 or something in the CDS. Rupert, what were you saying about the IG guys?
Yeah, well, they do not like having that done to them. I mean, their model is not set up for a 30 basis point fisting out of the gate.
It's just total fisting. And Rupert, as a guy who issued a lot of paper in his life, how often did you have clients after you issued paper and then it got dunked on right away? Were they very happy with you, or were Were they calling you, being like, "Hey, can I take you out to give you like a glass of bourbon? You know, like a little Louis Trey."
Yeah, exactly. This is
So,
not how. It's not a pleasurable conversation. Let's rattle through the rest of these.
Yeah,
right?
and so we have that chart on the right, and that's I have a model that I built that's dynamic, and basically we're looking at $2 trillion of credit, and the average guy looks on the balance sheet at 410 combined, and this, by the way, we're now have to add in SpaceX as well, and it's a lot of SPVs without recourse, right? Non-recourse SPVs, off-balance sheet financing. Those commitments are real. And, this is a lot bigger credit thing than people want to admit. And I'm not going to get into it here, but I have a whole nother presentation. Like, the private credit market is not in a good place, as most people know, right? You see the funding requests keep growing every quarter, right? And they're not being met. And so private credit funding is a problem. Private credit being the guys who are funding the other side of all this stuff. And then hyperscaler stocks getting drilled. The market's like not maybe fully understanding this is a fragile situation, much more fragile, because everyone, all they see is token consumption and blah, 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 and growth. And this is funded. This is the credit market, capital market issue right now.
Yeah, so I was thinking about this quite a lot at the weekend, because I wrote a piece on the dollar and rates, and for once wrote a Blind Squirrel Macro finally wrote a macro piece after a few weeks. But one of the observations that I was making is that the U.S. economy is becoming more Australian, right? What I mean by that, Gerard Minack used to describe the RBA down here as the most powerful central bank in the world, because whenever they move rates, because of the structure of the mortgage market and the corporate lending market here, the transmission mechanism is almost immediate. Right. And whereas corporate finance in the US, the mortgage market in the US is priced off the term rates market, right? Plus a spread, term plus a spread. But all of this hyperscaler financing in the credit markets is linked to SOFR.
Yeah, right? It's bank funding, right? It's bank funding.
Yeah.
It's bank funding with this weird gate of the funding for the private side, right? So they don't have the mechanism of a normal bank where, hey, I can pull my money out and you can get SVB'd or you can get Lehman or whatever. That's the weakness of a traditional bank structure. These guys, the shadow bank has this you can get 5% of your money, or we can not 5% of your money. We can get 5% of the fund out a quarter, right? So maybe you're taking out more money than the other guys, so you could get higher percentage of your money. But point is, they can't they have an anti-bank run clause in their liability structure, right?
Yeah, but my point is their cost of debt is linked to the front of the curve.
100%,
right?
100%.
And where I was getting to with this is that all of this hawkishness that's coming out of the new Fed, right? I'm not sure he can move, because you blow up this funding complex, you blow up the whole PE private credit complex if you start messing with the front of the curve. And that was something that previous Feds didn't have to deal with, right?
I would say Bernanke.
Yes,
blew up the market. Whether he wants to admit it or not, he blew that market up. He didn't need to go where he went. The Fed always blows it up. That's what they do. They take rates to a point and then they blow it up. Just to go back to the .com, go back and look at June of 2000. Greenspan did what I like to call the death shot, 50 basis point hike, and that was it. That was the end of it. And then Greenspan kept hiking. Well, I guess the tech market actually ended earlier than that, and then he kept hiking, right? And so he wasn't accommodating like it was. But yeah, you can go back to the 70s, you can go back to 1929, they did a death shot. That's what the Fed does. They do death shots at the end. That's how they end cycles, basically. But anyway, so let's talk about this for a second. The credit market's paying attention. So, look, the equity market is too, right? Like I said, the hyperscalers' equity is getting derated. They've had a terrible month. But our friend SpaceX had an initial CDS that I think it was at 115 off the shoot, and I think closed Friday at 136. You look at the blue line, that's CoreWeave. And I don't remember exactly when we had a Mishan. It was that first week of June, and we were down in the 467s, and now that thing is up in 565. Oracle's at 175, et cetera. Like, credit market is paying attention. Like, people need to be aware that, like, the Mag 7 were the generals. Well, now you're being held up in the broad market by Micron and SK Hynix and Korea and like, I don't know, it just looks, when you look around, this market has been derated in a lot of areas that have been areas of strength for a long time. And just because the S&P is up here, I think people aren't really fully understanding what's going on, and especially because a lot of guys don't look at the credit market.
Mm-hmm.
So go ahead.
Yeah, I was going to say, you've got a couple more slides, and you wanted to talk about your new website.
Yeah. So this is just basically this idea. Okay, so the hyperscaler. Let's go back to last August, September, at the height of this. Right, that was the actual peak in stupidity. And hey, let's release a press release, and then boom, we just take it up hundreds of billions of dollars. And the peak of that was Oracle getting ripped up to 341, and it's IG sitting there at 45, and Meta was at 770. And then since then, Meta has been down and to the right. Microsoft has been down and to the right, and their credits, all the credit has moved out. But this idea of, like, commit to Capex, buy more chips, then that, like, gives more compute, like, agents, whatever, they're using more, and then it gives this narrative. And then, but it comes out, the Coinbase CEO comes out and says, hey, what I've been talking about, a open router, optimizing, using a harness the right way. Like, you can use these things and optimize your spend. Oh, maybe use Chinese models. Oh, maybe like what Rupert was talking about, like the GLM 5.2 local model, buy your own. So there's just things you can do.
That's a Chinese model too, right? It's just that it's something that you can run locally.
Yeah,
right?
exactly. And it comes out that guys are going to start putting these local models into computers when you buy them and stuff. And so this idea that you're going to be on the cloud to do it is a big, big question mark. And I think it's one of those things, like housing prices don't go down, like every bubble. And as you guys know, I'm writing all these essays about bubbles, and now I've codified it, and we'll talk about it at the end. There's an assumption that underlies a bubble. There's a hardcore assumption, and then usually there's a bunch of capital. And the worst ones are when there's credit. Equity bubbles are whatever they are. They're just, some people lose, some whatever. But like, when you put credit, it becomes an issue. And so I think the key thing to watch is this whole reflexive loop, and is it fracturing? And then what can cause it to fracture? So I created a website. Let's go to that real quick. And I'm going to give that out to my subscribers, access to it. But it's real-time updating, and you can click into these things and basically, and then go to the next one. But it has the linkages. I've created a free cash flow to zero countdown monitor. We're at 78 days. But I have a sensitivity. You can say, okay, well, this is what I think it's going to be. More spending, the days go down. Less spending, it goes up. But back to root, and there's like a real time. Here's what's going on. Is it bullish or bearish for the narrative? You can export the data from it to yourself. So it's like pretty good, because everybody's trying to aggregate this, and that's kind of what I spent day doing.
Tell me how this doomsday clock works up there.
It's basically the amount of Capex spent, right? And then versus their cash flow estimates. And then so I have a sensitivity bar that you can toy around with on the website. And so, if you say, oh, we're going to spend more, they're going to hike up Capex estimates, which, by the way, during the height of the bull, up until Q3 of 25, they were getting rewarded for more Capex. Since Q3 25, they've been getting hurt, or whatever you want to say. Like, they're getting dinged for it. And so that's not new, right? We're a couple quarters into that, okay? And so there's a point here where these guys are going to be sick of this. And so the trade, that you got to see thinking about is, do I want to be long the hyperscalers against the things that are the winners, right? Like that trade, which is way crowded, and because everybody's funding with and shorting hyperscalers, and then everybody's long SMH and Micron and SK Hynix, and Gavin Baker's talking about the HBAM and all, whatever, dude. Like, end of the day, it's about the capital markets. this is spending from the capital markets. Squirrel's point about SOFR and my point about the actual, return on investment that we've talked about. And will this continue? Right now it's open, but as I just showed you, credit markets are going the wrong way for them. And I did this analysis that shows like there's a point like for CoreWeave above 800, they're toast. Like there's this like, and for the private credit in general, it starts to be that reflexive downward loop, right? You go from a virtuous cycle to a vicious cycle. So, most tech guys don't understand funding markets, right? Like that's just not what they do. And then,
I think Silicon Valley Bank proved that, right?
Well, yeah, but I mean, also like most Wall Street guys don't really understand AI. So it's like a weird thing where like, because I'm involved in an AI company and I've just always been in markets, kind of like can fence these. And like, it's just a weird credit because everyone kind of understood housing, for the most part. And the first .com was not a big credit. The telecoms had some, but it wasn't like, these are big numbers, right? And so it's just a different beast. And I think what you got to pay attention to is what are estimates? What's the language? Oh, by the way, OpenAI delayed their S1 last week, right? And why did they do that? Why is the government like being like, oh, well, we'll put some stakes in, or we're only going to give it to these people? Like maybe they're trying to say, oh, if we do that, then everybody else will beg us to get the model and they'll pay up for it, right? Because they know that they're in a spot right now where people are realizing there's low cost alternatives, or maybe I don't really need the Ferrari, and they start to think in a fragmented sense, right? And so that is where I think it's like there's an understanding of market participants, and there's understanding more and more by nobody knows how to calculate ROI or getting ROI. And yeah, I mean, I can tell you personally, Rupert, as you know, because you get a lot of it, I create websites, I create apps, I create research things. I don't know. Some of it's monetizable, some of it's not, but like, it's still running tokens regardless. So like, that's where I think it comes out at is like, you can do so much more, but should you be doing more? Like, is it just spending for spending's sake? And then is there a point where you're like, well, dude, I'm now spending thousands of dollars a month, or millions in the case of some of these enterprises. And like, let's pump the brakes on that. You know what I'm saying? And I think we're getting to that point. And the real question is the sustainability. I think if you look around and you analyze the market, you analyze all the different monitors I look at, more and more articles, more and more pieces being like, is this sustainable? Capex sustainable? Is the is the Meg 7 stock prices trading like this? Like, where is the breaking point in the credit markets, et cetera, et cetera? And so that's kind of what I try to encapsulate with that.
Yeah, I mean, listen, that pair trade, that long SMH short mags is clearly the trade the dominant trade that's on. I mean, the equal weight S&P is doing pretty well relative to them. That trade has kicked off really well for me. Listen, let's switch gears here and get back to some macro, because I spent last week thinking a lot about the dollar and where we are with respect to a new Fed chair and Walsh. And one thing I thought was quite fun to dig out was, there was a lot of purring of approval about Walsh's opening statements on price stability and conquering inflation, but that's just exactly what every other Fed chair has ever said in the past. So this is effectively like the first policy speech after a Fed chair appointment going back to 1978, and they all say exactly the same thing. It is crazy, kind of
right?
And yet we're sort of Pavlovic dogs in the market that we still react like it was something brand new. But so I touched on this sort of Australianization of the economy a little bit, and I do think that this jawboning has definitely got the bonds to behave themselves a bit. But what has happened, which I thought was really interesting, is that are we finally seeing do we call it when we got Brent Donnelly on the show and said that FX Vol was the dog that didn't bark? I mean, it's finally picking up.
You mean that, like, basically the idea that it's finally going to happen, like right when we said it'll never happen?
Well, it's quite interesting that, look, if you look at this, is just a breakdown. My buddies at Augur Infinity do this really good financial conditions index, which breaks it down by contributor. FX vol, which I've boxed in the chart on the right there, has done all the work on the tightening of financial conditions, really, since early June. So yeah, it is working. I mean, and FX vol is the tightening function.
Yeah, I mean, I think we've said that, right? I mean, I think I've talked about this idea that the BOJ has to catch up and, you know, take real rates closer to positive, you know, and so if that happens, then that just is the doubt. Like if you want to have a catalyst, like that could be the catalyst that kicks off FX vol. FX vol fucks up the carry, and then, you know, it just disrupts the whole credit and equity markets. And I agree with you. I think FX vol, and we've talked about this, like that is the lever, in my opinion. And it's hard because average market participant, they're not an FX vol. You know what I mean? Like they're not thinking about FX vol, right? Like, I mean, it's hard enough post this Swiss bank fiasco in 2015 to even try and trade FX unless you're, you know, an institution or a big hedge fund, let alone variance swaps on euro, you know, GBP vol, right? What are we talking about?
Exactly. But you know what? You know, we joke about jawboning central bankers, but it's kind of working, right? If you look at this, is the latest BofA Fund Manager Survey, right? They have, you know, they've got 40% of the market to believe in some kind of hike possibility for this year, right? Up from nothing, effectively. They have, and they've done that while keeping them completely unbothered about the risk of a hard landing, right? They've got investors to completely unwind their US dollar underweights since the lows of last year, right? And they've also got them starting to sell their overseas stocks, right? Which you know, which I happen to think is a very bad idea, but there you go. But it's bloody working, right? It's just another case in point that you know, we so, and then again on you know, inflation expectations, right, across the curve, right? It's this slide I wanted to show, right? They've brought those into heel, right? And then the final topic I wanted to talk about was the oil dollar relationship, right? And again, you know, because I've probably got too large an oil position on right now, it's something I'm giving some thought to. But this is the rolling correlation, 90-day rolling correlation of the trade weighted dollar, right? Which I think is the one you really need to look at here, and crude oil. And you know, historically, up until Goldman went and financialized oil by creating the GSCI and building massive swap businesses on it, there was very little correlation between the oil market and the dollar, right? Up until the early 2000s. And then we financialized the hell out of it, and oil just became another risk asset. And, you know, it was a risk on asset. And, you know, you had this crazy negative correlation that really didn't get unwound properly until the shale boom.
Yeah, I was gonna say, I think a lot of that chart right there is just the shale boom, right? Like,
yeah,
you know,
exactly.
The post TMT credit boom, dollar boom, like that was over, and the Wall Street just wouldn't accept it, and then we just tanked the dollar to keep it going, basically, and then you know, created a bunch of insane leverage to the point where they stopped even printing M3, and those ass bags called it. You know what? They said they stopped printing it. The cost. The guys that can print money had the goal to put a press release out and say, we're not going to give you statistics of the broadest money supply because of the extra cost. Like, I mean, that's when I knew it was effed, and it was time to be all in on gold, all for the rest of my life. And that's that. These guys.
Well, so bringing it back to the present, my base case thesis is that, Walsh is kind of trapped, at least
Totally.
with respect to rates. I don't think that they can really afford to hike beyond possibly
No
a
question,
token.
no. Yeah, I mean, look, we're already above. We're back above where it was, the day that he had his announcement and the market had a little panic attack, or it was mostly positioning, I'm sure, right? Like some guys got blown out of their positioning, but we're right. I mean, our Z7s are back in 90. Those are a buy. Look, I haven't really changed my view on that. I mean, why are they there? Like, let's just be honest for a second. Why are we sitting at 96.15 now, but oil is damn near round tripped back to right when those things at the beginning of the war were at 97 and change, right? And what are we doing? Like, that's an 85 basis points difference. And we're just seeing the Meg 7 be weaker. We're seeing ROI questions. Like, we're seeing all kinds of stuff. So what are we talking about here? Like, just because this guy like gave some Rupert's thing about showing everybody's always going to try and come in and be a hawk and try and be tough guys is right. Like these guys always do it, with the exception of Yellen. But she was just a placeholder at best.
Well, interestingly, I didn't include the chart in here, but it's in the free section of my notes, so people can track it down on my website. But I had a look at the performance of the trade-weighted dollar in the first year of every Fed chair. Janet Yellen, up 11%. She's top of the leaderboard. The funny thing is that Volcker he put 700 basis points on Fed funds in his first year, and he only got the dollar up 120 bips. Okay, it did go higher, but it then came back. But 12-month view was only 120 bips. But anyway, just to remind people, I know everyone's getting focused on summer holidays over there right now, but we do have quite a lot of quite a lot of big economic prints over the next 2 weeks, and I guess everyone will see what they need to see out of these various numbers and statements, which is why I like to call it the Warschach Test. I'm very pleased with that name. I wish it'd been the title. It's going to be the title of the show instead. Is there anything you're watching in particular, Ben?
I mean, in terms of rates, are you talking about?
Yeah.
I mean, I think that basically I don't really care about any of this stuff as much. Like, I think that the payrolls, like, when jobs will roll, obviously is usually what matters. Inflation's a lagging indicator. I don't care. That will be maybe it'll be something, but I don't think that really matters. I think it's just you watch employment and you watch, more important, spending, right? So what are the drivers? Is Capex spending. Okay, so that's why I built the website that you guys, if you want to come subscribe, I'll give it to you, access to it. Or you want to be paying attention to where the funding's coming from. Private credit, where's the funding going to be coming from? And like the government deficit's there as a buffer, but it's not growing really all that much. So it's not like that's a driver. It's just not contracting yet. And maybe that's a risk that will start to have to be priced also, that we're not even talking about at this point, because the midterms are coming up in fall and Trump is not popular. And if you get some guys in there where you have a change of the House and Senate, well, they're not going to be passing pro, Trump bills. And James Carville, the famous, Democratic strategist, comes out and says, I think Trump will resign next year. So we could be at the point where we're at peak Trump Silicon Valley shenanigans that we just saw, and the market will have to start pricing some of these things. And we're, it's the 4th of July week, as you said. So, but they're already doing it, and so in the meantime, we get a huge rotation. But is that rotation real, or is that just a classic carry unwind? Like, healthcare and staples up a big on Friday, small caps and RSP to your trade. Like we saw that in July of 24. And it's just a funding, like, hey, I'm short this stuff, I'm long this stuff. We unwind it. I don't know. Are people really allocating to it? Or is it that everybody's all in? Just reallocation can put money to that. And when you're super unallocated, things can go up quite a bit. I don't know. What do you think?
Listen, I'm certainly in that camp. Listen, let's wrap the thing up. We are hoping to have a smart private credit guest on Thursday. Just need to firm that up. Otherwise, everybody have a fantastic week. I think it's time for Benny and the Squirrel out.